Hey everyone, the purpose of today's video is to give an overview of one of the three main financial statements, the income statement. First, I'm going to explain what the income statement is. Then, I'm going to walk through an example income statement. And finally, I'm going to give an overview and compare and contrast a few of the different earnings or profitability metrics. So to start off, what is an income statement? The income statement outlines how much profit a company generates during a period of time. Now, the two key words in this definition are profit and period. First, profit. The income statement tracks how much a company earns after paying all of its expenses, and these include both the cash and non-cash expenses, which is important to note because given profit accounts for non-cash expenses, it's not the same as cash earned, which is outlined on the cash flow statement. Second is period, and it's important to note that the income statement tracks results over a period of time, usually a month, quarter, or a year. Now that we know what the income statement is, let's take a look at an example. So the first line item or row that you'll typically see is revenue. And revenue outlines the amount of money received from selling the company's goods and services. Now the second line item you'll typically see is cost of goods sold. And this outlines the direct cost to produce a company's goods and services, which usually include material and labor. When you subtract cost of goods sold from revenue, you arrive at our first profitability metric, which is gross profit. The second category of expenses you'll typically see is selling, general, and administrative expenses, which outline the cost to market, sell, and deliver the company's goods and services, as well as any additional costs to manage the company. When we subtract SG&A from gross profit, we arrive at earnings before interest, taxes, depreciation, and amortization, which is also known as EBITDA. Next, we have depreciation. And depreciation is the expensing of a tangible fixed asset over its useful life. So to think about this, when we buy machinery, the costs do not all flow through the income statement on day one. Instead, we estimate what the useful life of the equipment or machinery would be, and then we expense a portion of the cost each year over the useful life. Next, we have amortization, which is very similar to depreciation, but it's for intangible assets, such as patents or trademarks. Now, both depreciation and amortization are non-cash expenses. Once we subtract depreciation and amortization from EBITDA, we arrive at our next earnings metric called earnings before interest and taxes, known as EBIT or operating income. Then we subtract out interest expense, which are the costs incurred by a company for borrowed funds, such as corporate debt, and then we arrive at taxable income, which we use to calculate our taxes for the year, and once we subtract out that, we arrive at our last profitability metric, which is known as net income. As we just saw, there are a number of different earnings or profitability metrics that are captured within an income statement. The common metrics include gross profit, EBITDA, operating income, which is also known as EBIT, taxable income, and then net income, which is also known as net earnings. So to start off, gross profit is the profit a company makes after deducting the cost to produce the company's goods and services. Now, gross profit is typically used to evaluate how efficiently the company is managing its labor and supply costs. Second, we have EBITDA, which is a profit a company makes after deducting the cost to produce a company's goods and services, as well as the cost to market, sell, and deliver those goods and services. Now, EBITDA is typically used as an estimate for a company's free cash flow and is commonly used to help arrive at a company's valuation, as well as used when the company is looking to raise debt. If you're interested in learning more about EBITDA, I'll leave a link to a video in the description below that gives a more in-depth overview on this profitability metric. Next, we have operating income, or EBIT, and this is a profit a company makes after deducting the cost to produce the goods and services, the cost to market and sell and deliver those goods and services, as well as depreciation and amortization, which are non-cash expenses. Now, operating income is typically used to analyze the profitability of a company before taking into account any interest or taxes. Next, taxable income includes everything that was included on operating income, but now we also subtract out interest. And taxable income is used to get an estimate or calculate how much a company will pay in taxes. Finally, we have a net income, which is a culmination of all of the earnings metrics before, but now we also subtract out taxes. And net income is used to analyze how well the management team runs all aspects of the business, everything from managing its labor to its capital structure. This is because it incorporates all cash and non-cash expenses that the company incurs within a time period. All right, after watching this video, I hope you now have a better understanding of what the income statement is, as well as better understand a few of the different earnings metrics that show up within an income statement. Now, if you enjoyed this video and found it helpful, please like and subscribe below. Look forward to talking to you guys again soon.